Is your investment strategy performing below expectations? Are you not seeing the returns you hoped for? Well, before you start panicking, it's important to understand that markets are cyclical, and some years are just going to be better than others. But if you've been consistently underperforming the market, or you're just not comfortable with your current strategy, there are some definite red flags that might indicate it's time for a change. In this video, we're going to be going over 12 signs that your investment strategy might need a change. I'll break down each of these signs, explain why they're important, and give you some actionable steps you can take to get your portfolio back on track. One of the biggest signs that your investment strategy might need a change is if you're consistently underperforming the market. Now, it's important to remember that no one beats the market every single year, but if you're consistently lagging behind benchmarks like the S&P 500 or the Dow Jones Industrial Average over a period of several years, it's a sign that something might be wrong. This could be due to a number of factors like a poorly diversified portfolio, high fees, or simply not being invested in the right assets. The key here is to compare your returns to a relevant benchmark and see how you stack up. If you're consistently underperforming, it's time to take a hard look at your strategy and see what needs to change. Diversification is absolutely crucial when it comes to investing. The old adage, "Don't put all your eggs in one basket," absolutely applies here. If your portfolio is overly concentrated in just a handful of stocks or sectors, you're taking on a lot of unnecessary risk. A well-diversified portfolio should be spread across a variety of asset classes like stocks, bonds, real estate, and even alternative investments. This helps to mitigate risk and smooth out returns over the long term. If your portfolio is lacking diversification, it's time to branch out and start investing in other areas. Portfolio drift happens when the original asset allocation of your portfolio starts to shift over time. This can happen for a number of reasons, like market fluctuations or simply not rebalancing your portfolio regularly. For example, let's say you started with a 60-40 portfolio with 60% in stocks and 40% in bonds. But after a few years of a strong bull market, your stock allocation has ballooned to 80%, while your bond allocation has shrunk to 20%. This means you're now taking on more risk than you originally intended. To avoid portfolio drift, it's important to rebalance your portfolio on a regular basis, typically every 6 to 12 months. This involves selling some of your winners and reinvesting those proceeds into your underperforming assets to get back to your original target allocation. Chapter 4. High volatility. Volatility refers to the ups and downs in the market, and it's something that all investors have to deal with. However, if your portfolio is experiencing extreme fluctuations in value, it could be a sign that your risk tolerance is misaligned with your investment strategy. For example, if you're nearing retirement and your portfolio is heavily invested in high growth but volatile tech stocks, you might not be able to stomach the potential for big losses. In this case, it might make sense to adjust your portfolio to include more conservative investments like bonds or dividend-paying stocks. Chapter 5. Ignoring economic trends. The economy is constantly changing, and these changes can have a big impact on your investments. Factors like interest rates, inflation, and GDP growth can all affect how different asset classes perform. Ignoring these trends can be detrimental to your portfolio. For example, if interest rates are rising, it's generally not a good time to be heavily invested in bonds, as bond prices tend to fall when interest rates rise. Staying informed about economic trends and adjusting your portfolio accordingly is crucial. Chapter 6. Emotional decision-making. One of the biggest mistakes investors make is letting their emotions dictate their investment decisions. When the market is doing well, it's easy to get caught up in the hype and make impulsive decisions. On the other hand, when the market is down, it's easy to panic and sell everything off at a loss. This is where having a solid investment plan and sticking to it is crucial. Your plan should outline your investment goals, risk tolerance, and time horizon. Having this plan in place will help you stay disciplined and avoid making emotional decisions that could hurt your portfolio in the long run. Chapter 7. Not meeting financial goals. Your investment strategy should always be aligned with your overall financial goals. Whether you're saving for retirement, buying a house, or your kids' college education, your investments should be working towards those goals. If you're not on track to meet your goals, it's a sign that your investment strategy might need a change. This could involve adjusting your asset allocation, increasing your savings rate, or even revisiting your financial goals altogether. Chapter 8: High fees and expenses. Fees can eat into your investment returns over the long term, so it's important to be mindful of how much you're paying. This includes things like expense ratios on mutual funds and ETFs, trading commissions and advisory fees. Even small differences in fees can make a big difference in your returns over time. It's always a good idea to shop around and compare fees before investing in anything. There are plenty of low-cost investment options available, so there's no need to overpay. Chapter 9: Poor risk management. Managing risk is a crucial part of investing. It's impossible to eliminate risk entirely, but there are steps you can take to mitigate it. This includes things like diversifying your portfolio, investing for the long term, and having a solid understanding of your own risk tolerance. If you're not comfortable with the level of risk in your portfolio, it's important to make adjustments. This could involve moving some of your investments into more conservative assets or simply reducing your overall exposure to the market. As your life changes, so too should your investment strategy. Major life events like getting married, having children, or retiring can all have a significant impact on your financial situation and your investment goals. For example, if you're getting close to retirement, you'll likely want to shift your portfolio to a more conservative asset allocation to preserve your capital. It's important to review your investment strategy regularly and make adjustments as needed to ensure it's still aligned with your current life circumstances. Your time horizon refers to how long you plan to invest your money. This is a crucial factor to consider when developing your investment strategy. If you have a long time horizon, like 20 or 30 years until retirement, you can afford to take on more risk. This is because you have more time to recover from any potential losses. However, if you have a shorter time horizon, like 5 or 10 years, you'll need to be more conservative with your investments. This means investing in assets that are less likely to experience big swings in value. Taxes can have a big impact on your investment returns, so it's important to consider the tax implications of your investment decisions. There are a number of tax-advantaged accounts available, like 401(k)s and IRAs, that can help you minimize your tax liability. It's also important to be mindful of things like capital gains taxes and dividend taxes when making investment decisions. If you're not sure how to optimize your portfolio for tax efficiency, it's a good idea to consult with a financial advisor. So there you have it, 12 signs that your investment strategy might need a change. Remember, investing is a long-term game, and it's important to have a strategy that's designed to help you reach your financial goals. If you're not comfortable with your current strategy, or if you're not seeing the results you're looking for, don't be afraid to make a change. Review your portfolio regularly, stay informed about economic trends, and don't be afraid to seek professional advice if you need it. Consistent underperformance, lack of diversification, portfolio drift, high volatility, ignoring economic trends, emotional decision-making, not meeting financial goals, high fees and expenses, poor risk management, changing life circumstances, misaligned time horizon, ignoring tax implications. Review your investment strategy regularly to ensure it aligns with your goals and risk tolerance. If you're not sure where to start, or if you'd like help developing a personalized investment strategy, consider reaching out to a certified financial advisor.